The RRSP deadline for contributions is fast approaching, March 3rd, but there's another date to mark on your calendars. If you're looking for ways to lower your 2024 tax bill, you can still donate to charities until the end of this month, February 28th, to get a tax receipt for the current filing. Nicole Ewing, Principal Wealth Planning Office at TD Wealth, joins us to discuss both of these options. Nicole, always great to see you. Let's talk about the RRSP, because the first thing, it does many things, but it offers flexibility.
It really does. So we have the opportunity to make a contribution this year in 2025 to be credited against our 2024 contribution limit. So we have the first 60 days, which brings us, after weekends are considered, to March 3rd. So we're able to make a contribution to our RRSP that allows our money to grow in a tax-deferred environment, compounding year over year, so a very effective strategy. But by doing it at this time of the year, as opposed to in 2024, we have the luxury now of knowing what our 2024 tax situation looks like. We know all the different types of income. We know what credits and deductions will be available to us. And that allows us the opportunity to think about our contribution quite strategically to make sure that we're maximizing the impact that we're able to make. So we can take into consideration the income that we've earned, what we expect to be maybe having this year. We're also able to coordinate with our spouse. So if our spouse is also thinking about their retirement savings and we're in different income brackets, we might want to be thinking about spousal RRSP contributions, which allow us to use our contribution limit, deduct that contribution from our taxable income for the year, so we pay less tax, but our spouse then becomes the owner of those amounts, and provided they stay untouched for at least 3 years, ultimately when those funds are withdrawn either from your RRSP or from the RIF, ultimately they will be taxed in the spouse's hands. So this is a very effective strategy for some income splitting opportunities in the right circumstances. It allows us to maximize our tax savings both now on a current basis by having that deduction against our taxable income, but also in the future from a family unit perspective in retirement to be minimizing the overall tax. We want to be thinking about this as well, not only for our retirement. We do have the ability to take money, borrow money from our RRSP towards a home or for education via certain government plans that are in there. So really, in 2024, we know what our situation is, but now looking back, we can really think about how we can strategically be contributing to our RRSPs this year, in this current month, to really maximize the benefits.
It's interesting, too, because, I've been talking to you for an awfully long time, Nicole, which is remarkable given how young we are. But anyway, and I was saying, I didn't actually know that you could contribute to a spousal RRSP, even if you're over 71, if your spouse is below. That's fascinating.
Isn't it fascinating? So people think about their contribution limits and what they're bringing, what opportunities they have, and generally think about RRSPs kind of ending at 71. What you're able to do is, even after you're over 71, to the extent you have contribution room, which, as you know, carries over year to year. So here I am over 71. I have contribution room available. I can make a contribution to my spouse's RRSP. It will reduce my taxable income for the year. I'll have the deduction, but we're able to make that really effective transfer where we have a difference in ages between the spouses. So it's one of those unknown tips that people can be thinking about.
All right, I need to move on to the next one. I just will say, because I know you want to say it, that people need to make sure their beneficiary designations are up to date. That's all we're going to say about it right now. We'll talk about that one later. Charitable donations, that deadline has been extended. Also a great way to help somebody and get a tax deduction.
It really is. This allows you to make a contribution to a charity of your choice, to extend your values, but we're able to do that now because of the extension to February 28th for those contributions, to be able to make a donation that reduces your 2024 tax. It can be used as a tax credit in 2024 for individuals, or a tax deduction for corporations who are making that contribution. But anything that you're making, those donations that you're making now, can be used against your 2024 limit, against your 2025 limit, and can be carried forward for the next 5 years. Now, I do caution, though, that there are some restrictions around the type of contributions you're able to make. So we're not talking here about that very effective strategy that we love, where we have donations in kind, or we have accrued securities. This is only, the extension only applies to cash, to checks, to credit card payments that are being made. It does not apply to payroll donations or to those donations in kind. So individuals, corporations, and graduated rate estates that have a year end of November 14th, 2024 to the end of December are able to utilize this extension of the charitable deadline, which is normally December 31st and is now February 28th. So again, looking at our overall strategy for last year, we know what our tax situation is. We know how we can maximize any contributions that we're making. Again, if we have a spouse, we're able to coordinate those contributions or those donations as well to maximize the benefit for the family and for your charities.
I've only got about 10 seconds here, Nicole, but the one thing I just wanted to mention is from a technical standpoint, this is based on a news release, and that just there's something because people need to keep in mind when they're looking at this as well too, huh?
Right. So you may hear that the CRA is following the administrative position that the government had previously announced, this extension. This in particular has been done in the past in similar circumstances, so it's not unusual for retroactive tax legislation to be passed, and we do have precedent for it with respect to the extension of the charitable donation deadline.